Hello, everybody. This is Ben Tchaikovsky. Welcome to yet more intermediate accounting, some income taxation fun. And let's go ahead and read my disclaimer and copyright notice. The information and opinions of this presentation are those of myself only, and not any employers or affiliated organizations, including but not limited to Irvine Valley College in the South Orange County Community College District. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. The presentation is copyright 2008 to 2026 by Ben Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. Throughout the presentation, I will make reference to publicly available information that is the copyright of other parties. I do not claim any right to those third parties. Okay, so let's take a look at additional problem one. And let's jump right into this. Okay, so right over here, YYZ began operations at the beginning of 2028. The following information relates to this company. So we've got pre-tax financial income for 2028 was $300,000. The tax rate for 2028 and future years is 25%. Differences between the 2028 income statement and tax returns are as follows. Warranty expense for financial reporting purposes was $30,000. However, for tax purposes, only $10,000 of expenses were deducted on the tax return. YYZ expects that the remaining warranty obligations will be paid in 2029. Income from construction contracts using the percentage of completion method per the books was $100,000. However, for tax purposes, it amounted to $50,000. The project's expected to be completed in 2029. Depreciation expense for financial reporting purposes was $80,000. For tax purposes, the amount was $100,000. Interest earned on tax-exempt municipal bonds was $25,000, and then insurance on premiums for key person, also T-Man life insurance policy, amounted to $21,000. Okay, so compute taxable income for 2028, prepare the journal entry to report income tax expense, deferred taxes, and income taxes payable for 2028. Prepare the footnote disclosure for income taxes with current and deferred income taxes. So the way we want to do this is I would really start out with what is the pre-tax financial income. And we'll start this over here at $300,000. What I then want to go and do is to identify essentially what we have as our permanent differences. And the reason why we want to kind of go through and to do that is really that if we identify the permanent differences first, then that's going to get us to our true taxable income, or I should say, the true pre-tax income subject to income tax, and then we'll deal with the temporary differences, or the one we're going to be determining how we're going to be determining our income tax expense. So the first one here is warranty expense. This is a temporary difference. Why? Because it's going to be reversing in the following period. So warranty expense for financial reporting purposes was $30,000. However, for tax purposes, only $10,000 were deducted. So that's going to be a temporary difference. We'll deal with that in a bit. Income from construction contracts. This is also a temporary difference. Remember, we're going to have to pay on it eventually. Depreciation, also a temporary difference. But let's take a look at interest earned. So right over here, so my interest earned on municipal bonds is not taxable. That was included in getting to this. So I'm going to reduce my pre-tax financial income by $25,000 because that income is not going to be subject to tax. Remember, I have to include it to get to here, but it's not going to be subject to tax. Insurance on premiums for key person life insurance amounted to $21,000. Now, this is non-deductible, but I did deduct it when I came down over here to my pre-tax financial income. So I'm going to add this back. Okay, so my income subject to income tax is going to be $296,000. Now, let's take a look at our temporary differences. Okay, so our temporary differences for letter A for the warranty. Okay, so for the warranty, I deducted $30,000 for financial reporting purposes, right? So I took warranty expense, warranty liability of 30,000, and I deducted that to get to this 300,000. However, what it's telling me is that, well, this is only 10,000 were deducted on the return. So therefore, I'm going to have to add back 20,000 worth of expense because all this is a temporary difference. This is going to be a deferred tax asset that I will hopefully be going through and recuperating later. So that's my warranty. The next one over here is my income from construction contracts. And why is this a liability? It's because, well, I deducted 30,000 for tax purposes. I can only deduct 10. So this is going to create, I have to pay tax on that 20,000 of expense. So it's going to basically be an add back. Now for the income from construction contracts, I reported $100,000 to get to my pre-tax financial income. However, for income tax purposes, only 50,000 is subject to it. So this is going to reduce my income subject to income tax by 50,000 from this temporary difference. Let's go to letter C. So my depreciation expense for financial reporting was 80,000. That's what I deducted to get to here. But for taxes, I can take 100. So that difference here of 20,000 will basically be going here and putting as part of depreciation expense. So my taxable income is going to be over here at a total of $246,000. So that's my taxable income. Now, prepare the journal entry reporting income tax expense, deferred taxes, and income taxes payable. Well, for this one here, my income tax expense, I'm going to have income taxes payable. And then I'm going to have two different components over here. This warranty is going to be what we call a deferred tax asset. Why is this? Because I'll be able to, in a future period, I will be able to, if I have the income and if I spend the money, the cash outlay relating to this, I'll be able to go through and to deduct it. So this is going to be a deferred tax asset. And then here, I'm going to have a deferred tax liability for these two items here. Why is it a deferred tax liability? Because I got deductions here, and I'm basically these will ultimately reverse. Remember, these are temporary differences. It's a liability because I will have to pay the tax at some point. So to record income tax expense, it's going to be my journal entry, right? So when it comes over here to doing this part, my income tax expense is going to be $296,000 at 25% or 74,000. So my tax rate for here is 25%. My income taxes payable is going to be my taxable income at 25%. Now, for my deferred tax liability, this is really going to be a combination of these two items here. Or 17,500. Now, for my deferred tax asset, you know, if I was just kind of going through here and saying, well, 74,000, 79,000, this has to be 5,000. But really, where is this coming from? This is coming from the warranty where I'm going to get a future benefit, multiplying that by 25%. So right over here, and this is going to be as of 12/31/29. Yep. Hold on. That's probably 12/31/28. Sorry. Okay. So this is going to be what my journal entry looks like. And let's just make sure this kind of makes sense, right? So these are my permanent differences. They're not, this is tax-free. This is not deductible. get here to my 296, got my warranty. I basically took 30,000, but we say, no, you can't take it until you actually spend it. You've got to pay the cash for it. So this is an add back to my taxable income. I got to basically then report this as a deferred tax asset. Why are we reporting this separately? I have to keep track of my assets and liabilities separately because the assets may in fact have, I don't want to call it an impairment, but we may need to go through and to take a valuation allowance against it. So when it comes over here to my deferred tax liability, this is going to be the two parts over here at the tax rate. So this now balances out. Now, in terms of my provision, okay, so my current income taxes, or my current income taxes, call this income taxes, current income taxes deferred, income taxes deferred liability. And if we go ahead and look at, and I've been continuing to reference this throughout this over here, but if we look at this, could we are they combining them here? I mean, it's again, I would kind of go through and prefer to list them out separately. But again, if on an exam, probably would want to see, I would at least need to see, you would have to probably, I would probably want you to break it out like this. So if I look at this here, my income taxes current are going to be my income taxes payable. My deferred tax asset right here is at 5,000, and then I have my deferred tax liability. So my total tax provision, my income tax expense is going to be the sum of these three items or the 74,000. So this is how the footnote disclosure would potentially go through and look. If you are taking my class and you combine these, it might have to say it's okay. But again, for financial reporting purposes, I would probably say, no, you got to break it out. I got to see it separate because I'd actually be okay with you. I would actually be okay with you combining it because you're essentially showing this as a separate item on the balance sheet. So I don't know how many more times I can be wishy-washy, but in any event, thank you for watching. I look forward to seeing you on the next video and have a great rest of your day.